Okay, stop with the history lesson. Just tell me what ETF to buy. Totally understand. So I'll do exactly that. Here you go. For those living on your own and might be responsible for others, I personally suggest you don't invest anything with anybody until you have 3 to 6 months worth of expenses saved in cash and you have control of your personal costs in life. As a professional financial advisor, I think this is the hard stop. Don't invest until you control your costs and savings. If you're young and don't have the same responsibilities, then go ahead and start investing right away. I'm going to cover that entire process in another video for opening your first investment account and custodial accounts for minors. Disclaimer, investing can lead to losses. And at the end of this video, put more legal disclaimers. Second, I'm not going to endorse any investment choice, but I will share some examples of ETFs I like and why, along with how you can better research this category for your own benefit. Now, if you're currently with a company, let's say like Schwab or Vanguard or Fidelity, they probably offer you access to free research tools already. And I suggest you learn about all those free research tools offered by your brokerage provider. So here is the process to buy an ETF. Ready? The very first thing to consider is strategy. Example, if you're starting out investing, a broad index might be the best simplified approach to investing. The best example of this would be the S&P 500 index cap-weighted. I cover capitalization in our video for stocks, but simplified, cap-weighted places more emphasis on the companies based on their value, so the top 5 companies make up, let's say, 25% or more of the index, whereas equal-weighted means each of the 500 companies contribute the same to the index. So 500 companies equally divided equals 0.2% each. The version quoted in the news or online is most likely the cap-weighted version. And broad index funds are not just for beginners, as many investors believe the only investment you should ever make is a large, diversified, low-cost index fund. There's even an entire movement called FIRE. FIRE! I'm not going to do a bad impression. FIRE is Financial Independence Retirement Early, where the backbone strategy is often cited as placing all your investments into low-cost, broad-based index funds. So, once you have determined the strategy, I think the next step is to determine if you want to add some specialty sectors to your investment portfolio, or keep it general in the form of this broad index. And because ETFs could easily be structured for a narrow or broad market, your choices as an investor are great. A broad example with focus could be investing in a high growth, mostly tech and drug companies that's found in the NASDAQ 100, symbol QQQ issued by Invesco. Narrow examples allow you to express an investing opinion without trying to pick a specific stock. A great example would be lithium stocks, as many investors believe we are moving away from petroleum and where lithium and similar companies will benefit from that. With an ETF, you could buy lithium-oriented companies or a basket which also might include some clean energy companies. However, another investor might have the exact opposite opinion, and they think oil and energy are here to stay and even grow, and they could buy a basket of frackers, drillers, pipelines, refiners, and chemical companies. This type of sector approach is also known as theme investing. If you don't have any opinions, buy the broad market index or find a professional you trust and whose investing philosophies you appreciate. Look, plug for my entire industry and try to find a professional that acts as a financial fiduciary, because they legally can't sell you any product unless they could be demonstrated why that investment choice is best for the client over the benefit to the advisor. RIAs, or registered investment advisors, are types of financial fiduciaries. My partner Adam and I are both financial fiduciaries. Like many great entrepreneurs before him, in 1984, Joe Mansueto saw an opportunity in raiding all the mutual funds that were being created. More funds meant more choices, and more choices led to more confusion on which ones to pick. So, starting from his one-room apartment in Chicago, Joe created Morningstar. Now, as a professional starting my career, I pored over the details found in a Morningstar report, and filters were delivered each month on a CD. For our younger viewers, CDs were an ancient form of digital data storage and retrieval. Now it's all online and available in seconds. Some offer free info and some must be paid for. Another financial invention is for consumers who create their own baskets for investing. This creates this diversity. Schwab has a program called Slices. Stockpile.com has something similar, and so Robinhood might offer something as well. There's a thing called motif investing, works around themes. We covered a lot of knowledge in this breakdown of mutual funds versus ETFs, and even snuck in some comments on hedge funds. The point of all this knowledge is to help you become the best investor possible and spread the word to others so your investments are not just guessing or gambling, but fueled by an education process. And this intelligence can be the foundation for a lifetime of investing.